Hi, Gabriel Josiah here again. Okay, right now we're looking at another ratio, another liquidity ratio. In the last class, we looked at current ratio. Okay, so in this class, we'll be looking at quick ratio. Quick ratio is also known as acid test ratio. So let me share my screen quickly and let's delve into this ratio very, very quickly. So the quick asset ratio is known as acid test ratio. It's a financial metric that measures a company's ability to meet its short-term liabilities without relying on the sale of inventory. So you could see the difference between the current ratio and the quick ratio. Inventory is exempted from this ratio to see how this company is able to rely on other current assets aside inventory. It provides a more stringent assessment of liquidity compared to the current ratio. And this is why it excludes inventory from the current assets. Since an entity's inventory may not in most cases be quickly turned into cash, that means it may be tied down for one reason or another, especially if the company is not a fast-moving consumer goods company, it is eliminated from the current assets in calculating the quick asset ratio. So it's a more stringent test on the entity's ability to meet its short-term financial commitments. So let's look at how it's calculated. So our current asset less our inventory to have our current or quick ratio. So current asset less inventory divided by our current liabilities is what we have as our acid test ratio. So let's demonstrate this ratio with that our example. We've been looking at the company Sharabutu Nigeria PLC. Okay, so let's look at the total current assets. Let's pick it as our figure. Total assets, and this is our figure. Then we have inventory deducted from the total assets. So let's go and pick the inventory figure only from the total assets. So let's pick it and see. So this figure is deducted to have our net current assets. I want to calculate the acid test ratio. Beg your pardon. 100 minus 300 give us. Okay, I think there's an issue with the formatting. All right, so our total of 800 less 300 give us 500. Okay, so all right, so this is our non-current asset to be using, and let's pick our current liability figure. So our current liability from this company we're looking at is 400. So let's have that. This is 400. So our quick or acid test ratio is our current asset less inventory divided by our current liability. So you can see the company still passed the acid test because it's a test. Still have a good quick ratio of 1.25 to 1 inventory. So we have 1.25. I hope this works. The last time it's 1 inventory. Oh, it did. It worked. I tried the 2:1 in the last class with the current ratio and it did not work. So this work, I'm sure, is the format in the Excel. All right. So the quick ratio here is 1.25 times above the current liability. The current asset aside inventory is able to cover the current liability, which is also Very good. So let's go back to the discussion. Now, what does that mean? It means the quick asset ratio quantifies a company's short-term financial health by indicating how well it can cover its current liabilities with its most liquid asset. So inventory is not its most liquid asset because it could be tied down if the company is not a fast-moving consumer goods company. So its most liquid assets are the current assets less the inventory. Now, a ratio of 1 or above suggests the company has enough liquid assets to pay its current obligation. And from this example we just saw, you could see that 1.25 times above the current liabilities. It shows Shadow 2 in the year 2020, as at 31st December 2020. It's doing well. It's doing well. Now, what's the implication? The higher quick asset ratio implies stronger liquidity. It indicates the company can easily meet its short-term obligations seamlessly. On the other hand, a lower quick ratio may suggest potential liquidity issues, signaling the company could struggle to pay short-term debts, especially as with exempted inventory. Now, what's the cause and effect of a high or a low quick asset ratio? Now, the cause first is efficient cash management is the cause of a high quick asset ratio, low inventory levels, or significant liquid asset holdings. So these are the causes of a high quick asset ratio. And what is the effect? It enhances creditor compliance because you are able to meet your current liabilities easily and on time. Also, lower risk of financial distress and potential better borrowing terms. So any creditor will be able to borrow you funds because you're able to meet these obligations seamlessly. Now, a lower quick ratio or negative quick ratio, and the cause is high level of inventory tied down, poor cash flow management. Your working capital is not properly aligning with your goals and your business strategies, or also an increase in short-term liabilities could be a cause of low quick asset ratio. And the effect is increased risk of liquidity problem. If you're not able to meet day-to-day obligation, it's going to affect you drastically. It's going to affect the company operations very, very negatively, and a negative impact on your credit ratings. So creditors may be skeptical to grant credit, to provide you with raw materials or items for production. This is very risky for the business. Now, in conclusion, a quick asset ratio is a crucial indicator of a company's liquidity and financial health, offering a clear picture of its ability to meet its short-term liabilities with liquid assets aside inventory. So it's actually an acid test, and passing this test is very, very important for financial health of a company. So management needs to monitor this ratio, and as chartered accountants, in practice, you need to monitor this ratio because it helps stakeholders assess the efficiency of the company's asset management, especially its current assets and its capacity to respond to financial challenges without relying on inventory sales. This is very important. So your current asset aside inventory should be able to cover your current liabilities one time or above one. This is very crucial. All right. This is a nice liquidity ratio. I prefer it to the current ratio depending on the industry, especially when it has when the industry is not into fast-moving consumer goods. That's FMCG. All right. Let me know what you think about the acid test ratio or the quick ratio in the comment section. Your observations. You're welcome, and don't forget to like, share, and subscribe. So we're going to the next ratio so that you'll be notified if you click the notification button for the next video. And till the next class, bye for now.